Welcome to Big Business This Week. I'm JD Durkin here on the trading floor of the New York Stock Exchange. And while this may be a short work week for most, with the 4th of July holiday, of course, coming up, there's still lots to unpack from the world of business, the financial markets, the economy, DC, you name it. It's probably happening in the world of news right now. Who better to talk to help us better understand it all than Tony Zipparro? He is founder and CEO at EquitySet. Tony, thanks for being on the show this week.
Of course. Thank you for having me.
All right, so let me get your take here on the jobs number today, obviously, that we got, at least when you and I are recording this on Thursday the 3rd. A bit of a surprising push to the upside here, at least on the top line, and a big separation from what we saw from the ADP private payroll earlier this week. What have you made of the labor data we've gotten the last couple days?
Yeah, I mean, just like you said with what came out yesterday, you figured you were expecting a big number potentially down or a big miss. And I think the big takeaway is, who knows, right? We can't even predict it, right? The revisions down week over week. I think it was the last 6 or 7 weeks there's been revisions down. And then all of a sudden we get a good jobs number today. And so obviously a good part of why we're seeing a pop. Right, and kind of the markets, hovering and continuing to push all-time highs, and so it's. I don't know if I believe the big push up. I think only time will tell, and over the next month or two, really kind of get a clearer picture of what that jobs number is, and so I think it's good for the short term, right? The next week, 2 weeks, 3 weeks, but again, your guess is as good as mine what those numbers are going to be every other week.
Yeah, I'm curious how you would diagnose or kind of see the current state of the U.S. labor market, because the hard data paints one picture, and then of course we talk a lot about the so-called soft data, the survey sentiment gauges, asking people how they feel about the economy, where do they think their personal economic situation is going to be in the next year, and that's oftentimes much more of a sour batch of responses. But what do you make of the actual hard data that shows us for the most part, moderating job growth, but still pretty strong economy by most accounts?
Yeah, the hard data is good, and that's where, again, been continually surprised, because when I talk to individuals, whether they're looking for jobs or we're trying to switch, it doesn't seem like it's that promising, and so that's where I'm continually waiting for it to hit the hard data, and it hasn't, and so it's made me, and I think a lot of the market participants kind of like, okay, well, until we start to see it trickle through in the hard data in a meaningful way, that's what's holding a lot of the market together, and of course earnings resilience. So it's been surprising, and it's kind of made me put my own beliefs of, well, this should be in the data and we should be seeing it, kind of put them on hold until actually can believe that those are coming through. And so I've been surprised that it's not been a lot more flow through, because what I'm hearing from people is, again, job market isn't as good as it was a year or two ago.
Yeah, we're seeing the number of people who enter unemployment stay on unemployment benefits for longer. We're seeing companies not quite put a full-on hiring freeze, but maybe a hiring pause. It's kind of like the labor market was in an all-out sprint, and now it's kind of coming down to a jog. It's not collapsing, but to me, it's just a labor market sort of taking its breath, and we're seeing that kind of reflected month over month. One of the bigger stories of layoffs this week involves Microsoft. 9,000 jobs. It's a significant percentage of its total workforce. How do you approach headlines like that, specifically in the tech sector or white-collar job displacement? We don't see a ton of those headlines, but when they pop up, they're certainly worth paying attention to.
Yeah, absolutely. And when I saw some of those numbers or planned layoffs, first thing I did is try to understand, okay, if this has a ripple effect amongst, let's say, the 10, 20 largest components of the S&P, what does that mean for the hard data? And I wanted to believe it was bearish, right? You kind of run these extrapolations and be like, oh, if every company has to cut, X percentage of the workforce. And the reality, just like we were talking about there, is it didn't have a big enough negative effect to be like, oh, it's rising unemployment that much. Now, getting to the fact of when we're looking at Microsoft with those layoffs, obviously the stock is pushing all-time highs. I think it's good from a cost-cutting perspective. I think it's good for corporate profits. And that's the thing that I think is, with the breadth of the market so narrow, these companies, they're doing the right things to cut, and they haven't seen the decline in revenue and profits, and so it's only helping to boost the bottom line. So I think corporate-wise, right, for Microsoft, it's great right now. Obviously bad for the job market in the longer term.
Tony, I wonder, how are you approaching or thinking about the potential for AI job displacement? It's been somewhat muted We're hearing more chatter about it, and a few CEOs really sounding the alarms about what it could mean for future layoffs and white-collar positions, legal fields, analysts, marketing, whatever it is. What's your sense, and how much thought have you put into what that looks like even in the next, let's say, 2 to 3 years?
Yeah, and that we've seen some headlines where CEOs and different investors are calling for it could displace 50%, right, of a workforce even in the next 2026, 2027. I feel like it's something to pay attention to. I feel like with AI and even using it and working with other clients, right, that are using it more heavily, it's maybe got a longer road until it can displace those. I think the top companies, right, the top AI companies and tech companies can figure out how to utilize it, but a lot of the mid to smaller companies, you still need somebody to help run it, to help manage it, to help understand it. And so I think some of those numbers, while they could be true, right, for, again, the Microsofts, the Metas, NVIDIAs, things like that, I think it's going to take a longer time, right, years, right, potentially 5 to 10 years to see that displacement in medium to smaller enterprises. And so I do think it's a real risk, especially as the labor market starts to soften. But does it happen in the next 6 to 12 months to spike unemployment to 6, 7, 8%? I mean, as bearish as I might be on valuations, I don't think I can count on that to be the leg lower.
Are you bearish on valuations, and if so, why? What concerns you from what you're seeing, especially now a couple weeks ahead of the next tranche of earnings season?
Yeah, and it's I am bearish on valuation, a lot of valuations. So I should say there's a lot of companies that have good fundamentals, have good values, and kind of have been left to kind of flail about. But I think when we're looking at the top 20, 30 stocks, right, in S&P from a valuation, like indexes are hitting multi-level or multi-decade PE highs, right? CAPE ratios, Buffett indicator. I'm sure you've seen them all. Its debt's increasing. Again, GDP is potentially slowing, and we've gone up 30%, almost in a straight line, with no more than a 3.5% kind of drawdown. And so, while I'm not super bearish on the economy and not calling for a crash, it's just I can't get behind anything, whether it's a company, whether it's index, right, that it just moves up like that without a meaningful correction. And so I think, again, hitting all-time highs, it continues the bullish, right, aspect, but with volumes declining, right, obviously all the numbers about institutional, right, and hedge funds not participating in it and retail investors kicking it up, I just see a lot of signs that show why would you put your money to work here when you have maybe a 5 to 10% upside and a 20 to 30% plus downside? So just from a risk-reward ratio, I don't see the bullish valuation story playing out.
Yeah, it sounds like you may think that bears may come more out of hibernation. Just one more on the broader market. As you and I are chatting, we're at 62.78 in the S&P 500. Do you have a year-end target or any thought of things you'll be looking for in the second half of 2025 for a market that by virtually all accounts here, Tony, has surprised to the upside?
Yeah, and it's bears are scared to come out of hibernation, like you said, because every dip, every little crack down was bought up aggressively right over the last month or two. And so I think that plays into it of, unless there's something big, why are they going to come kind of put their neck on the line? And so I have what I view as, for a year end, I think the S&P could easily be at 6,500, right? About 4%, 5% higher than here. Now, what do I think it should be, just for realistic valuations and kind of taking euphoria out? I think we should be somewhere around 5,400, 5,500, right? Which, again, that's not that big. We were just at 4,800, right, 2 months ago. And so
August 7th, yeah.
Yeah, and so that's right. I think we've hit euphoria in full stride. It's kind of like 1999, right, with a lot of these names shooting up. I think there's going to be some sort of credit risk or crack in the market. And so realistically, I'm positioning, there's certain equities, right, that have good value that have not the valuations that some of the major tech companies and components do. But I'm slanted more bearish, right, in terms of I think we should at least see an 8 to 10% correction back.
Yeah, what are any of those other, and you mentioned a couple of them, maybe we see some cracks in either deterioration of the labor market, You mentioned a potential credit event. Are there other big picture things that kind of keep you up at night that you're concerned about?
Yeah.
You know, we hear a lot of chatter about the government's inability to refinance its debt. I mean, the government's paying $1 trillion a year right now simply on interest payments on the debt, and that number is only expected to get bigger. Are there big structural things like that are giving you pause right now?
Yeah, and they were when bond yields started to spike, right, and kind of there was that tantrum the first time around the tariffs. Markets seemed to pay attention, right? They kind of again snapped back. There was some resolution there, but they've largely ignored it since, which has taken me aback a little bit, right? Because I think that's a big thing, right? And I think it's not until so again the issue, big beautiful bill, right? We passed that, and regardless of how it's helping individuals or businesses, if it's adding that much to a deficit, I just can't get from an economic, right, U.S. longevity standpoint. And so I think at some point, whether it's Monday or whether it's 6 months of Mondays from now, the market's going to look at that being like, wow, this isn't sustainable at all. This is terrible, right, for the economy, and they're going to put credence in it, and there's going to be kind of downdraft. So I think debt, delinquencies, right, affordability of housing, the real estate market is basically a zombie right now in terms of a lot of areas are taking price hits, mortgage rates are high. So I think at some point those credit spreads, right, and that credit risk is going to come into the market in a meaningful way and just bring some bearishness with it.
Yeah, well, since you mentioned rates still being high, it's a great pivot back over to the Fed. Okay, so I haven't seen the recent expectations. Now, I think it's pretty safe to say a cut is off the table now here for July after the jobs data earlier today. But for a very data-dependent Fed, if you were a voting member of the FOMC, what are the key pieces of data that you're looking at to inform your decision about at long last? Do we resume interest rate cuts, or do we need to still be cautious and wait and see?
Yeah, and not that matters. I mean, if I'm voting, I think we'd have a totally different policy outlook here. But I think they're actually doing it. They're analyzing inflation and jobs data correctly here. I've disagreed in the past years ago when I felt they kept rates too low for too long, and some of the transitory inflation, right, carried through to what I consider now very impactful price hikes that, again, are sticky, they can't go down. So now I think they're actually doing it well. I would probably be the unpopular opinion about a month or two. I felt they should have raised rates just because of all the yields. Like there's cracks, there's a little bit of a huge sell-off in treasuries. I think that needs to be rectified, and that's where I've been surprised that the market itself has kind of ignored that because everything is pointing to the fact that we should not lower rates. And I think, again, the lower rate case is an emergency cut, and obviously we've got this drama between, obviously the government, right, Trump and Powell on that front. But that, as much as I might have disagreed in the past, I think keeping rates steady is the right move. If anything, which again is in the unpopular camp, I think they should raise a quarter point.
How do you approach the idea of erosion of trust of the Fed, in part because of the unusual public friction that we're seeing, at least from the White House, aimed at the otherwise very stoic, very quiet chairman of the Federal Reserve, who seems intent by all accounts to keep his head down and do his work? Yeah,
I actually think he's helping to build a better case of trust for the Fed, right? To kind of put his foot down and say, hey, I'm going to do what's best for the economy, because that's kind of like we talked about just a minute ago. I think the data's pointing to there should, for no reason, be a cut, right? Because the cut's just going to increase cheap money, investment in things that shouldn't go, euphoria, right? Asset bubbles. That, sure, a cut is good for home buyers and things like that, but it's not good for where we're at in the economy. So I think it's actually doing, for the people that are looking at it a little bit more pragmatically, it's doing great sentiment for building that trust factor of that they're going to do what the economy needs. And so that's where I do think from an investment standpoint, right, from a market standpoint, the market also believes the Fed's going to do what the market needs. If we have a big credit event, right, they're probably going to fold a little bit and they're going to start printing money, right, QE, whatever needs to be done. They're not going to let institutions or the economy fail. So I think that's always in the backstop, right, of financial institutions and investors' minds. So I think I'm glad to see that he's standing his ground. What I'm a little nervous about, right, is a shadow Fed chair or right, a new nominee coming in and immediately cutting rates, because I think that's only going to perpetuate, again, euphoric action that is not good for the market medium term.
So I'm glad you mentioned that last part, Tony, because this has been my take. I've been wondering now for the last month or so. If President Trump goes ahead and names prematurely a successor to Powell, and Powell still serves out to 2026, at what point does the market start to take its cues from what that person says before he or she is chair of the Fed and starts to discount or discredit public commentary from Powell, even if Powell's still going to be in the world of the Fed after serving as chair? You set up a very interesting and kind of thicky dynamic for the market, don't you?
Absolutely. And that's where I think investors are opportunists. So as soon as if that comes out a month from now, hey, and they might not have any control, right, the shadow Fed chair over that. It's the belief that it will happen, and the market will move immediately, and it will probably move up. And then we'll deal with the consequences later. And so that's, I think, the biggest thing over the last couple of years is it doesn't really matter lately what's actually happening. What matters is that you're on the right side of the trend, because nobody is willing to step in front of that bullet train and get hit.
What matters isn't actually what's happening. Out of context, doesn't make much sense, but in context for the world we're talking about, it's the perfect description. It kind of reminds me of the old, like, good news is bad news is good news. I feel like today for the jobs report, maybe good news was actually kind of good news, but we'll see how that plays itself out. Speaking of things, Tony, we're waiting to see how they play themselves out down on Capitol Hill. I do not envy the difficult task of being a Capitol Hill reporter ordering pizza at 3 a.m, as these procedural votes, not even the vote on the reconciliation bill itself, just a procedural vote. Hakeem Jeffries, the leading Democrat, on the floor for more than 5 hours to essentially try and filibuster this thing and block it. There's a lot of political theatrics behind passing a bill like that. There's also a lot of pretty serious market implications as well. What are you looking for as it appears we're inching closer to getting the bill on the president's desk?
Yeah, and it seems almost like a foregone conclusion, right? There's been so much fanfare, and that's, again, every headline about it has had a positive market, right? Or I should say a positive price impact in the market. And so I think a blocking of it, right, or a stopping of it would be very surprising. And I think that could be a catalyst, at least, right, for a couple percentage move down. But yeah, it's just the headlines. The headlines seem to focus on the things that don't really matter, right, for the medium to long term of the economy. And so, not politically tied either way. Again, kind of like I said, is I'm just hoping a bill that increases, that does not directly and quickly focus on the deficit and declining it, right, and actually does the opposite. I just don't think is what the American people, right, should have, and that we should take on. And so I think it's interesting, a couple weeks ago it was tracking the number of pizzas ordered and bar activity around the Pentagon and DC for the war efforts, right? And that, again, all the headlines, there was not a bad headline, no matter how bad it was, that could roil the markets. And so I think it's similar in this case. I think it is interesting going into the longer weekend, right, that we're dealing with this. And so my belief is it gets through, however it has to get through and however long it takes them. I think that then is a temporary positive pop, especially for industrials, defense, right, banks, right, deregulation. But I think quickly, right, within a week or two, some of that could be eaten up and some sense comes back into the market to be a potential blow off.
Yeah, you're referencing there the Pentagon Pizza Index, which is very popular for political super sleuths on Twitter. Okay, while I still have you, let me just ask you real quick here about trade. I mean, man, if we went back to the April 7th lows, that was the only thing we were talking about, and then suddenly talk about short-term memory. It's like the fifth biggest catalyst on the markets right now is like a trade deal. Like, what just happened to that entire 20% dip we had from February 19th? Okay, so we are looking for deals here involving Vietnam, Canada. Obviously, there's a disproportionate impact for tariffs on companies like Nike and Lululemon that have moved a lot of their production to those countries. What are you looking for in terms of trying to give the market a bit more stability, more answers on the tariff front?
Yeah, I mean, what tariffs and the taco trade, right, for the most part. I see, just like you said, it hasn't been a mention in any of my news feeds other than the 20% Vietnam, the other day, which I find very almost concerning, but ironic that we're 6 days away from the trade deadline, which has been described in many facts of it doesn't matter, and then oh it does, or we're not making trade deals. And so that's another potential catalyst that I don't know why the market is ignoring. And I think it's because they just think, hey, the date's going to come and then they're going to push it more. But absolutely, I think that's something that is not being priced into a lot of different names, right? As we just ignore it, and they're going to see when it comes, right? Come July 8th, we're going to see what the headlines say. I think a lot of people are expecting it to just be pushed or, again, just to be more euphoric for the market on that sense. I'm going to lean a little bit into the opposite. I think it could have a negative effect because we've been having that positive effect so long. And so trade deals, like, again, just looking for what they are, right? What are these tariffs? What are these percentages? Why, if negotiations were going well, we should be hearing about it, and we're not. And so I just don't understand how, after this long, right, and the 90-day pause, like you said, it was the focus at 4,800, and before that, and now everything's hunky-dory. And so I just can't, again, get behind that camp of, I think it's going to turn from a positive sentiment to a negative sentiment headline. Unless, and I wouldn't be surprised if July 9th come out and say, all right, we're just scrapping the whole tariff idea altogether.
Yeah, can you imagine after a 20% drawdown to the April 7th lows, so we're around 48 and change, like you said, we're now up more than 24% off of that. And if that's how this whole thing ends up settling, hey man, risk on. That's the environment we're in right now. The S&P 500 back up now 0.8% on this shortened trading day and shortened trading week. Tony Zipparro, founder and CEO at EquitySet. Thanks for doing this. Terrific interview. Appreciate your time.
Yep, thank you.